Thanks for joining. I'm Ross Bramwell from Hammerberg's Investment Department. The Fed's mission is to promote a healthy economy by having a stable inflation target, maintaining full employment, and pursuing financial stability. The Fed closely monitors several economic and financial indicators in their work. With the recent bank failures in the headlines last month, the terms tightening financial conditions or tightening credit conditions have been used frequently in interviews and articles. Many analysts have commented that the market is doing the work of the Fed, or that the bank tightening is doing the work of the Fed. So maybe the Fed can pause earlier. But what do those terms mean? Let's briefly discuss what these terms, financial conditions or financial tightening, credit tightening, discuss what those terms mean and why they're so important to the Fed and also to the markets. Monitoring financial conditions is important for assessing the impact of monetary policy on financial markets and also for keeping an eye out for potential financial instability. Measures of stock prices, the strength of the US dollar, market volatility, credit spreads, long-term interest rates, and other variables are sometimes combined into an index to create an overall measure of financial conditions at any given point in time. Movements in these indices are sometimes cited as reflecting the impact of changes in monetary policy on financial conditions, which in turn impact consumer spending decisions. For example, housing or purchasing services or goods, and also companies' investment decisions. Many different indices of financial conditions exist. Some Federal Reserve banks, such as the St. Louis Fed and the Kansas City Fed, shown below, have their own indices. The various indices generally include different components or put different weights on those components. Some are designed to reflect the level of stress in financial markets, whereby a high value would be an indication of disruptions to financial markets or financial crisis. For instance, the St. Louis Fed Financial Stress Index is designed such that 0, shown here across the chart, would represent normal financial conditions. As seen in the graph below, the St. Louis Fed Financial Stress Index in maroon rose above 9 in October 2008 in the midst of the 2007-2009 financial crisis, and also above 5 in March 2020 during the early part of the COVID-19 pandemic. The St. Louis Financial Stress Index did what it was supposed to do, which is indicate financial stress. Both of those periods were associated with sharp recessions as well. The Kansas City Index in tan showed a similar trend. While the St. Louis and Kansas City Fed indices remained at a low value through early March of this year, financial stress has been on the rise in the wake of the recent bank failures, as we see in the far right side of the chart. The policy response to these events has been swift. The Treasury, FDIC, and the Fed have used some of the tools that were developed in response to the 2008 financial crisis in order to limit the damage to the broader economy, but there still has been a significant impact. Other indices are designed to be more reflective of tight or loose financial conditions, which would be indicative of a tight or loose stance of monetary policy. While the broad overview that an index can provide is useful, looking at the individual components one by one instead of putting them together in a singular measure could also be just as instructive. Here we are looking at bank lending standards and whether banks are tightening or loosening standards at any given time. Higher standards would lead to less credit available to businesses and consumers. Here we can see that over the past several months, there has been a significant tightening kind of across the board on the availability of credit for large and small companies, credit cards, auto loans, and commercial real estate. The decreasing availability of credit will have a direct impact on the growth of the economy, but it can take several quarters for this to work through the economy. When the commentators say the market is doing the work of the Fed, it's referring to the fact that the Fed wants to slow the economy to bring down inflation, and its main tool that it can use is to raise interest rates. However, with the recent bank failures and the immediate impact that many banks have retreated and have restricted availability to credit, that decrease to credit growth in the economy will be a headwind to future growth. Many believe that it will lead the Fed to stop raising rates or potentially not to raise rates as high as initially expected. The banks, they say, are now doing some of the work of the Fed. Here is just another way to look at similar data. This chart shows the annual growth in bank credit, the amount that banks are lending across the banking sector through the economy. And it illustrates that we have seen a significant drop over the last year in credit growth. Long-term average credit growth has been around 6%, as seen in the blue line on the chart. But historically, when credit growth drops below 5%, it has been associated with a slowing economy. Over the last year, the Fed has raised the target range for the Fed funds rate by almost 5% in an effort to bring inflation back down towards the Fed's 2% target. The Fed has provided forward guidance on the future path of rates, but right now the markets and the Fed are not on the same page as markets are pricing in rate cuts during this year. The risk is that not all businesses or even consumers have adjusted their businesses or finances appropriately to the changing interest rate environment. We'll continue to watch the underlying data, which we believe right now still indicates a likely continued slowdown in economic activity this year. Thanks for joining. If you have any further questions, please reach out to a member of your client service team. Thanks again.